Good afternoon. I'd like to welcome you to CNFT's webinar on 3-2-1 methodology. I got started with the market profile, which basically is a statistical overlay on the market, a way of looking at the market through the laws of statistics, in the spring of 1986, and I've been with the market profile ever since then. By 1992, I developed software that took the profile in the direction that I wanted it to go in, which was volume as opposed to time. So I am the originator of the time, price, volume overlays and the long-term statistical distributions that we'll talk about when we get into the presentation. So when I first was exposed to the market profile, my feeling was that technical analysis that I had pretty well exhausted over about 3 years wasn't all it was cracked up to be. There had to be a better way, a way of capturing the information from the markets that made sense, that really reflected the way that the markets operated, and that to me is the market profile. I have not changed my mind since the summer, early summer, late spring of 1986. So this is the basis of our webinar, what I've done with the market profile. Plenty of people out there tell you about the market profile, value area highs, lows, etc. But we really go deeply into the market profile, the dynamics that drive it. We base all of our studies on volume, not time, price, opportunities, and we give you a methodology that is based on the information in the profile, very, very specific to that information, and that's what differentiates us from the rest of the people that teach the profile or promote it. In the first and second quarter of 1986, the Chicago Board of Trade introduced the market profile to its clients, and that's the home, or was the home, of the Treasury notes, the Treasury bonds, etc., or the capital markets, and it was instantly accepted by the banks and the large primary dealers that did trade in those markets. As a fallout from that, because the banks took to it quickly, Forex, or foreign currencies, trade a lot based on profile information. So I'd like to get into this right now, and once again, thank you very much for joining us this afternoon. Brief disclaimer right here. We have to acknowledge this. You have to know what you're talking about and what you're getting into when you trade futures too. Trading futures, options on futures, retail off-exchange foreign currency transactions involves substantial risk and loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. The lower day trade margin, the higher is the leverage, and therefore the riskier the trade. Leverage can work for you as well as against you. It magnifies your gains as well as your losses. Past performance is not indicative of future results. The placing of a stop or stop limit orders, which are intended to limit losses to certain amounts, may not be executed at the designated price, and market conditions may make it impossible to execute such orders. So be aware of this, know what you're getting into, and then proceed as wished or desired. The market profile is based on statistical distributions. When Pete Settlemyre was standing on the pits, the grain pits, the Chicago Board of Trade, over 3 or 4 days, he says, you know, this kind of looks like a bell curve. And I wonder if we could come up with an information system that would capture this activity and see if it actually does look like a bell curve. And Pete got the exchange started in 1982. He and Sherry Beyer, and I forget the name of the CBOT's statistician, worked for 3 years on this, and they came up with a market profile. Friedrich Gauss was the originator of what was called the Gaussian distribution back in those days, which is now called a normal distribution. Normal distributions are extremely important to statistics and are often used by the natural and social sciences to organize and examine the data. This mathematical and geometric construct, the market profile, has made its way into the capital markets with much success. The classic market profile methodology was introduced to the public in 1985-86. The intent was to evaluate market value and price in a vertical Gaussian distribution moving through time. The resources where you can go read up more about it, Settlemyre has several books. Settlemyre on Markets, Trading with a Market Profile, Markets in Profile, Profiting from the Auction Process, and then the one I really like the best is the original CBOT Market Profile Handbook. Gives you the original intent and how it was constructed and how you could use it. So lots of reference materials. The biggest thing was that most Gaussian distributions we look at are laid on their side like this, or normal distributions. What they did is that they turned it on on its side, and you can see that right here, and they put price on the y-axis and time development on the x-axis. They just basically turn the distribution on its side. Statistical distributions and the market profile. When we first started out, we just had letters like this, and you could combine them and put them all together into the market profile, but each letter stood for a specific period of time, and this is the way that you looked at it. And what you're looking at right here is a half-hour bar chart with letters as opposed to vertical lines. A volume, as it became available in 2002, 2003, was added, but it was put off to the side. And the problem with this was that in the beginning of the day, you couldn't miss the high volume and the low volume numbers, but as the day progresses, they just kind of fell into each other. They were pretty hard to see, and that was disconcerting to me. So I further developed my software and came up with this depiction. And what you can see right here is that this gray shaded area right here is the volume overlay that I put right on top of the letters, or the TPOs, and I made the highest volume price magenta or red like that, and I made the length of that volume bar equal, come out and touch this vertical pink bar, so you could not miss the skewing. And that was really, really important, because if you ascribe to the theory that markets go up because there's more buyers than sellers, then if volume is moving up in a distribution, the market should go up, and if volume is moving down in the distribution, the market should go down. And that was my big insight into the markets. So this would be my first contribution to the market profile world. My second contribution was this long-term distribution on the right, which is the historical trades done at those prices. It sums it up and it gives you a count for all the contracts that were traded at a particular price. So this is the roadmap, or the long-term structure of the market, and of course on the left this is the most recent activity, and the combination of these volume points with the long-term distribution can really help you in order placement. So what's different today? In the classical market profile theory, we had time price opportunities, are called TPOs. At a specific time and a specific price, it represented an opportunity for an entity or an individual, and they took the trade. The profiles were isolated back in those days. Every day was a single profile. It stood by itself. It was not integrated into the previous data. And so that led to a lot of trading on perception. You could just look at a single profile and you made your best guess as to what was going to happen the next day without that integration in the past. So this isolation or segregation of the individual profiles greatly limited the people's ability to use it. In 1988, 1989, with Don Jones, who runs Cisco Future, I knew there was something better than just time price. It just wasn't working as advertised, and it was volume. And I got that by studying the liquidity data bank, which was offered back in those days. So in 1992, I came up with some software that simulated the volume that was being done each day by just calculating and counting the number of price changes at a price, and that represented volume. Not perfect, but it was a pretty good. So my software showed time, price, volume in 1992. I also made my software, gave it the ability to combine distributions, and each day in trading is not an isolated event. It's a part of the whole, and you have to integrate what happened today back in the past. You have to integrate backwards. So knowing how to combine individual market profiles and then split them correctly also has a great deal to do with the success you're going to have using the market profile information. This combination and splitting of the distributions took you from perception to reality. I mean, this was the market, and this was how it was trading, and this is which way the volume was moving through the distribution. Therefore, it gave you the direction of the next trade. So this unification of price and volume is probably, in one word, the key to success in using volume as opposed to time will make you a better trader. Market profile had an immediate appeal to institutions, like I said, the large banks, the market makers in the cash market for treasuries just jumped right on it. The professional trading community took to it very quickly. Some of those traders were off the floor, some of those traders were on the floor. So it was very widely accepted. So between the professional trader, the locals, and the large institutions that hedged their positions, upwards of 70% of the volume could be controlled by those three entities. And if 70% of the volume is controlled by people that are making decisions on the profile, you better know the profile strictly out of self-defense. The time frame selected after for backtesting all the contracts in the Chicago Board of Trades database was a 30-minute time frame. Fast enough, catch all major moves, slow enough to eliminate about 90% of the noise. It does show you the market's bias and the market's direction. It is efficient price information. It is reality. It's what's happening. This profile right here is exactly what happened. Yeah, there's not a mathematical overlay. You're not trying to impose your opinion on the market. And the thing, one of the really nice benefits about it, it forewarns of directional changes at least 30 minutes and usually 45 minutes before the fact. So here we have an I period low. Here's the JL low. Here's the M low. Here's the P low. And then you can see the market goes ahead and trades on up and establishes a high in the W period before the day session opens. The day session opens right here. The market comes up and it retests the high it holds. Here's your DE high. Here's your F and J high. And here's your P high. And then the market goes ahead and spills and heads lower. Also in this pattern right here, you can see it's pretty pronounced B from a volume standpoint, and volume wins and the market does eventually break. So these volume bars right here are very, very important, and you need to pay attention to how they move through a distribution. So one of the problems with the profiles, there's so many ifs, ands, and buts. A lot of people left it early on because it's just too complicated. You know, if you weren't a part of the industry, if you weren't already a trader, I mean, the profile wasn't going to help you. So what I wanted to do was organize the data, simplify it, put it in a cohesive whole that had practical application, i.e. you could trade it and not be overwhelmed. So we came up with 3 rules, 2 patterns, and 1 indicator. So that's the 3-2-1 methodology. 3 rules, 2 patterns, 1 indicator. 3-2-1. The 3 rules: low volume numbers are support and resistance and should be traded as such. You can have a limit sell, a tick or two inside this low volume number, and if it holds, you will go back to the high volume number without a doubt, unless you get a new piece of news. So you could have a buy protective stop 2 or 3 ticks outside of this low volume number, so you were looking at risking maybe 3 or 4 ticks and you had a shot of this entire range, so it gave you fabulous risk reward. Now what happens in the auction process is the market rotates lower until the price is no longer attractive to sellers, or the price rotates higher until it's no longer attractive to buyers, and it comes to a balance. And this high volume number, or attractor, or what we call value, pulls the market back to it, and eventually this high volume number is going to be what is called the balance point. Now, a lot of people say this is a new move. When you take out this low volume number or chart high, that's the start of the new move. And what we find as traders is that 2 out of 3 breakouts are false. The exchange members or the locals are just gunning stops. So what we like to do is we like to let the market come to a balance. We like to enter the market here in this high volume area with what we think the direction is, so we can have trading profits when we get up to this low volume number. If it comes out, we've got trade location, and if it stops the market and it starts to trade lower, at least we've made a little bit of money on our trading, and that's why we like these high volume numbers. Now, why does a new move start out of the middle? There are no sellers, there are no buyers. There are buyers that need to get long, they're hoping to buy down here. There's sellers that hope to get short, they're hoping to sell up here. Then the market, large commercial orders, the market, it starts to move. The buyers will chase the market up. Those that were short from up here will have protective stops, which adds to the buying, and that's what propels the market up to retest resistance. And you can see this coming. You can see it develop, and it's pretty easy to stay with. The 2 patterns. If the skewing in the time price volume distribution is a P or P-shaped, then the market's bias is positive or to the upside. And you can just see right here a P, the market is trading higher. Right here, if we put all of these together, even though it is paused, we're definitely looking at a P and the market trades higher. So what we see in a P pattern, it's going to retest resistance and or take it out. And so we want to, in a buying situation, we want to get long at this longest line of letters or below it if possible. If the skewing in a distribution is B-shaped, then the market's bias biases to the downside or negative. And once again, you'll see you've got a pretty pronounced V. This is a B. This is a B. And if you put all three of these together, it's a great big B. And then the market does break and head lower. So we come into the market having really knowing whether we want to be long or short for the next trading day or whatever period we choose to trade. And that information comes from the skewing in these distributions. So that's our two patterns. Now, one indicator is deceleration. Markets move higher or lower. Eventually the buying or selling dries up, and our software will give you deceleration with this square or diamond that are over the letters. So here we have a high right here. We retest it another time, we retest it the third time. The bars are getting thinner. We know the buying is dried up, and when you break support, it's just off to the races. The market moves, and then it pauses. We get these little congestion areas, and what you can see right here is that we've got pretty good volume, but we have blue squares and diamonds, meaning the selling is dried up, and we have pink squares and diamonds, which means the buying is dried up. So which way is the market going to move? Well, you can look and see right here that we're dealing with a B. And if you had to make a trade at the market, you'd be a seller, and you can see that the market does break. So you can add a little bit of just common sense thinking. You don't have to be a rocket scientist or rocket surgeon to make this work, and you can do quite well. We've added more information to this screen right here. This is the buy and sell delta. This is the buying and selling in any bar, and if you went short right here on this bar, you'd like to see this red. That's your first confirmation that you've got a good trade. And our number 3 pane right here, this is cumulative buy selling, and you can see that the peak buying right here on this bar took place in this area, and longs liquidated, then the market started going short. Now you're sitting here moving sideways. I know it's a B. I want to get short. Is there more information here for me? Yeah, you can see that there is actually selling in that congestion area. These red bars are getting longer, so this gives you the feedback you need, the confidence you need to take that trade. So quick review right here. It is a sound methodology. It's been proven since 1992. Our rule table is very, very concise. It's short. You've got quantitative insights in the market that you can't get anywhere else. You can read the trader's motivations. You can see that there's more buying, more selling, and this volume adds reality to it. So our 3 rules define support and resistance. Low volume numbers and high volume numbers are support and resistance. You can see rejection of high volume and low volume numbers, which is what you want to know as a trader. Has resistance held? Has support held? And then the market comes to a balance and moves come out of the middle. Our 2 patterns, P's and B's, show the skewing within the distributions, our time, price, volume. More volume to the buy side, more trades being done on upticks, favors higher prices. More trades done on downticks favors lower prices. And then our one indicator is volume deceleration. So if the market is in a B and it trades up, test resistance, and we get a square or a diamond out of our software, that's deceleration. We take the short to try to get trade location close to the top of the B to retest that low. And the combination of these 3 things show the divergence in the delta of the buying and selling, which really, really help and can aid your trading. Now, I came from a military flying background, and you've heard of heads-up displays. Everything we actually had to know that was critical to safe flight was projected onto our windscreens. And I've tried to keep everything simple. I've tried to keep it visual. I don't want you to have to interpret data. I want you to look, see, and know. So our F1 screen is our capital flow screen, and from this comes the idea whether we want to be long or short. Then we want to buy or sell at a level that offers us an advantage, and that comes from the F2 screen, which is the market profile screen. And you can see right here that market opens right here. I've got volume right here. I'd like to be short above that volume if I can. There's your value area high, so you can get short up here. This offers you advantage. You've got volume right here. You've got volume in this area. If I can get through this low volume number, I can retest this volume down here. So I've got trade location, which is very, very important. Got deceleration up here in the form of only 1 tick. And so now we get down to the screen that we actually do the execution on, our F3 and F4. But what I wanted to show you first is this bar chart. You can be long right here, or you can be wondering about getting long. Got a question mark. So up we are. The market moves, it pauses. We go in these little congestion areas. Got a red bar, a blue bar, a red bar, a blue bar. Off of your bar chart, should I be long or should I be short? Well, I'm not getting a lot of information out of this, whether I should be long or whether I should be short. So what I did, I developed the F4 with Peter Nanis, F3 configuration, and let me show you what that shows you. Right here in this congestion area, you can see these magenta lines, and you can see that right here they're steady. Volume is holding. It hasn't given up and hasn't come back. Volume is higher on this bar, and volume is higher on that bar. And so if you weren't long, you could buy stop into the market off of this information and make yourself a nice little profitable low-risk trade. Once we're in, well, we enter the market on this screen, the F4 screen. Once in the market, we're on our F5 screen, and this is the auction screen. This is where you can see the actual trades going to the buy or the sell side. You want the auction to be going with you. You want more trades to be taken on the offer or on upticks than you do on the bid. So that's how we come in. That's how we do it. That's how our screens work for you, and it really can give you an edge up. And it's based on volume. That's what really drives the market. Price will get buyers and sellers into the market, but it's not what drives the market. It's the volume to the buy side or the volume to the sell side that you need to know to help your trading. Okay, I want to go over a trade that was in the room that several people took. In fact, one of our new members wrote this trade up. And so on coming into the last Friday's news on the 7th, it was a Newsday trade. It's the biggest news day of the month outside of FOMC announcement. And prior to Friday's news, the market had run up into it, and they were looking for a 245 plus or minus number for non-farm payroll. Coming into this, the F2 structure favors higher prices before the news. The news hits the market, and it turns out to be split. The headline is 214, but with the upward revisions, it came out at 245. So the number was actually a little bit better, or as expected. So we had split news. So what am I supposed to do as a trader? I got a headline that drove the market down initially. Now the market is trading up on 245, but it was expected news. Should I be long or should I be short? Coming into this, we like the long side, but big news can change things. I want to trade with the big boys, so how can I do this? And we'll go into our screens and we'll take a look and we'll show you how it's done. Okay, coming into the unemployment news, we have a very strong P here. Got to move kind of out of the middle. We've got a P into the close. And in the overnight session, we did on Thursday's close, we said look for some profit taking in the overnight session. It'll be a little higher, but we'll see some profit taking. So you can see right here, we kind of have volume, two little volume nodes, but there's more volume in the bottom half. So this is actually a B volume-wise coming into the market, and it's leaning B off of TPOs. So there was some profit taking or selling coming in, but the run up into the news was positive. People were expecting a good number, and if it had come in that 240, 245, the market certainly would have been higher. So here we are. The news hits the market right here, and the first move was down because it was 214. It wasn't 240. Then they read revisions for August and September, and the market traded up. Market comes to balance right in the middle. We got a lot of volume that you can tell by the width of the bar, and then it tries to trade higher. And these bars are very skinny, and they have our squares and diamonds over them. So people aren't really too interested in buying right here. So this is the first hint that we get. I told you down here in this pane, this is the 50 lot trader on the T notes. And you can see in this area, right up in here, that the 50 lot trader is a seller. So the money is going to the short side right here. So the big guys sold in to the retracement off that first piece of news. So the big boys are telling us to get involved on the short side of the market. Looking at our screen that we really like, and especially if you come from the bar chart world or the world of candles. Right here's the news, and this happens to be a 20 lot seller trader. You can see right here that the 20 lot trader was selling into this rally. And the 20 lot trader, most people think, is where the high frequency traders, the buy and sell programs, begin with a 20 lot trader. The 20 lot trader is selling into this rally. The market breaks. The 20 lot trader caused that break. 20 lot trader covers some shorts right here. The 20 lot trader is short off the opening and short all the way down to here, and the market does trade lower, but right here on this bar the 20 lot trader goes long, and you can see the market trades up. So we know what the big boys are doing, and like I said, we like to trade with the big boys, and these charts can really help your trading. if you learn to understand them and know how to use them. There are lots of versions of the market profile. You can just see everybody's got their own version and take colored letters, no colored letters, on top of each other, volume to the side, volume overlay, that most people have knocked off from me. But what very few of them have is a methodology that utilizes the information that the market profile throws off. We've got both. And we've got a trading methodology based on the information in the market profile that works. So CNFT has both, and that's how we differentiate ourselves from the other players out there. Now, to find out more about us and come visit us, this is our website, cnfuturestrading.com. We're very active in the social media. Every day on YouTube we put up a trade recap for our market, our trade recommendations made at 6:45 in the morning for the Treasury Note and the E-mini. And you can review that on YouTube and learn the methodology pretty quickly that way. We also have on YouTube our pre-market comments where we cover crude, gold, the euro, the 30-year, the 10-year, and the E-mini. And then after the market closes on YouTube we have a post-market summation or commentary that allows you to trade Globex. And Globex is a great market to trade. It's a much easier market to trade than the day session if you can handle the hours. And for those of you that live on London time or pretty close to it, it's an opportunity that we don't have in the States. Globex trades technically. It's controlled by market makers, and you know exactly off the market profile where they're going to be getting long and short. We have a special offer right here for the first month. Normally our charge is $295 a month, but for the first month to come in and take a look at us, it's $147.50. Get to play with the software. You have access to all of our educational library, all of our videos, all of our PDF files that are written up. To help you make this decision, right now we're offering a free 5-day trial. Come in and take a look at us and see if we are for real or if we're blowing smoke. We are for real. We don't blow smoke. And the sign up is come to our website and sign up for the free trial offer. There's a box there that you'll be able to see and take advantage of. Once again, contact us via email at info@cnfuturestrading.com. Our telephone number is 312-361-3895. Our website is www.cnfuturestrading.com. I'm looking forward to seeing you in the main trading room for your 5-day free trial off. In the meantime, before you come in and take a look at us, we wish you good trading.